Welcome to episode 13 of my Well Masterclass. I'm Edmund from Inspire. Recently, one of my clients asked me what is the difference between a term and a traditional whole life. Today, I will be sharing with you when should you buy a term plan and when you should buy a whole life plan. Okay, so both type of policies are good, are great, so that what are the salient difference which you should be considering. Okay, so for those who know me, I like to put things into very simple context, so it will be easy for even a 7-year-old child to understand. Okay, the question here you need to ask yourself is whether your problem or risk is it permanent or temporary. Okay, so if it's something that's temporary, for example 10 years to 20 years, then a term might be sufficient and it's of course cheaper. But you must be very certain that you do not need the coverage beyond that specific duration. So because when it expires, the coverage will cease and policy will end. And imagine if one is at 40 years old and his term plan ends at 60. If he wants to buy more coverage at 60 years old, okay, he will be running two concerns. Premium surely will be higher for sure, and his health will have to be reassessed again. And like I always say, money cannot buy insurance, and only good health can buy. However, there are another group of people who are not certain that they will cease their coverage at 60 or not. So they prefer to keep their options open and worry that there will be more health risks when they are older. So this group of people should consider buying a life plan instead. Generally a life plan is more expensive, slightly, but it can cover you for whole life, meaning you don't have to worry if the coverage ceases prematurely. And the premium payable for such life plans like this, either it's a single premium or it's a limited regular premium such as 5 years, 10 years or even 20 years. So to put things into context, imagine you bought a new house and taken a new mortgage loan of $1 million for a period of 30 years. So most people would rather pay a cheaper premium to buy a term plan that covers $1 million. And so in the next 30 years, if anything would happen to the insured, his family will receive $1 million to pay off the mortgage. But if nothing happens, his premium becomes a sunk cost. So suppose he has to pay $3,000 a year. His total premium will be $3,000 multiplied by 30 years, which is $90,000. So it's a $90,000 sunk cost. If you don't like the idea of sunk cost and wanted a plan that you could at least get back your premiums paid after a certain period, then a life plan is better for you. Okay, because a life plan has cash value component that can help you grow and accumulate higher returns through compound interest, and the returns are usually better than the bank's interest rate, if you ask me. So in a nutshell, you got to ask yourself these questions: is the risk temporary or permanent? Okay, do you prefer to have a plan with some form of returns, or you can accept totally zero returns? Therefore, there is no one-size-fits-all solution here. Every type of plans cater to different person which have different needs. So, it's better to consult your financial advisor to have clarity on this. If you have concerns, once again, I'm Edmund from Inspire. If you need my expertise, you can always drop me a text after this video for an appointment, and I really look forward to seeing you. So, meanwhile, please take care and stay safe.